Stocks deepening their losses Wednesday afternoon, the 10-year yield creeping up above 1.5% after the Fed released its monetary policy statement. Let's dig deeper into that statement with Liz Miller of Summit Place Financial Advisors joining us from New York City. Welcome back, Liz.
Hi.
So Liz, right now you got the Dow initially falling more than 300 points, now down 200 points. Why the hawkish reaction from the markets?
I'm not really sure why the market went further. I have to say, the market was down a bit today. In many ways, this Fed statement was exactly what the professionals, investors, and traders were looking for. The Fed updating its economic dot plot, taking into account that we are seeing arguably a stronger opening than anyone expected in the spring of 2021, and therefore an expectation that rates will start moving up in 23. As I think about this, I try to think, well, what would the market be doing if the Fed hadn't updated the dot plot as was expected? So I almost feel like this was going to be a market that pulled back no matter what came out of the Fed this afternoon.
Were there any surprises in the statement, Liz? As you pointed out, they raised their outlook they brought forward their projection for the rate hike into 2023. They also raised their outlook for inflation to 3.4% this year.
I think the surprises, if there were some, were we had a few more governors in that dot plot expecting to see an increase even in 2022. That was originally last time just a handful, 4 of the 18. This time we were up to 7. I think if we continue to see strength in this economy, we may see that pulling forward even more. The part that might be the disappointment to the bond traders in particular was there was some pressure to find out if they would talk about tapering, the phrase we all talk about, which really means adjusting the balance sheet more. Now, keep in mind the Fed really doesn't see the quantitative easing policies as core to its interest rate policy. They will make decisions about that off cycle sometimes. They will talk at various times. Right now, they said they're going to maintain their $120 billion per month in purchases. Now, that's not expanding the balance sheet. That is just maintaining the balance sheet. It actually does allow the balance sheet to shrink slightly over time, given what we still have on the Federal Reserve balance sheet. I wouldn't be surprised to see some update of that maybe come out of Jackson Hole in August. But today, that might have been the disappointment in the release if there was one.
And Liz, based on the Fed's new projection of its first interest rate hike, what would you suggest to investors in terms of repositioning their portfolios?
Well, when we start taking into account that rates are going to move up, 2 things happen. The bond market starts getting a little bit more attractive. We have seen so much of a move of assets into that very short end of the market, just looking for safe alternatives to cash. So slightly higher rates is very good for that part of an investor's portfolio. Higher rates do tend to bring down valuations in the stock market. We've talked about this when we've justified current levels. We've said with a strong growth outlook and 0% interest rates, many companies are going to be valued more highly. So the market is a discounting mechanism. Looking to 2023 for those first rate hikes, we may already begin to see some of those valuations start to come in just slightly based on higher interest rates.
Any sectors that investors should get into now in light of this statement? I mean, yields are going higher. Does that mean financials?
Financials have certainly already benefited in so many ways. I still think there is some upside there, but I would be watching them carefully before putting new money to work in the financial sector. I think this does confirm that you want some good cyclical exposure in your portfolio. It does say we are an improving economy. Remember, we're still coming off the bottom. So even with rates moving higher, you still want exposure to those materials, the industrials, the cyclical areas, including consumer cyclicals.
All right. Thank you, Liz, for your take on the Fed report. Our thanks to Liz Miller of Summit Place Financial Advisors. I'm Fred Katayama in New York. This is Reuters.